I'll move on to the 5-1 ARM program. And the 5-1 ARM is a great program. I do these normally a fair amount with investors. We're allowed to put investment properties in LLCs and do these 5-1 ARMs and kind of a commercial thing. So if you've got investors that want to put them in LLC, that's fine. We'll do a 5-year ARM up to a 30-year term, and they can modify at the end of 5 years. But for me to sell these to owner-occupied, I've sold more in the last 4 months of these 5-1 ARMs than I have in my career combined. So literally, people are grabbing these as an alternative to a 6 3/4 or 7% rate. I was at 6.875. I got as high as 7.5% on a 30-year fix. So you can see how an ARM product may be beneficial with the rising interest rates. And I think the main thing there is making your client comfortable with the talk of ARM. So I use fixed period ARM. And basically a fixed period ARM is any ARM product that stays the principal and interest rate stay fixed for more than a year. I'm going to use the example of a 5-1 ARM because it's our best seller, and I'll take you through that. They have 7 and 10 years. I don't offer those because the pricing isn't good, and I'd have to go through a third party. My 5-year ARM right now is at 4.5%. And when you're talking 6.875, 7%, you're talking huge difference in the monthly payment. They can kick it down the road if they want. So the fixed period ARB is just anything that longer fixed period than normally 1 year would be.
Is that also for commercial?
Yes, sir. So, yeah. Oh, I'm sorry, 4.5 is not for commercial. Commercial, if you're looking at an investment 1 to 4 family unit, residential, you're probably 5 3/8 with a 0.5 point is what I believe those are. So it allows the buyer a much lower interest rate and payment on a fixed term. This is great for buyers that need short-term financing or looking to refinance. Right now I sell these as let's kick the refinance down the road. Rates aren't going to stay high forever, and they aren't even high right now. But they can kick it down the road, and we're going to start to see some of these interest rate increases slow the economy, and then we'll see a slowdown of the interest rates increasing and hopefully come back down a little bit. So it is a Band-Aid to get them into a house with a low payment and a low interest rate, and it's fixed for 5 full years. So they can sit on that. They don't have to refinance it. It is not a balloon. It stays, it's a 30-year term. It will become a 1-year adjustable at the end of 5 years, but I'll get into that in a minute. They can even modify for another 5 years. You've heard the term buyers are not married. They're not married to the mortgage, they're married to the home. So you may want to pull that out of there. The average 30-year fixed rate mortgage literally lasts 5 to 7 years on the books altogether. People either refinance or they sell the home. So that's just, and you can throw that out there. So your 30-year fix is only going to last 5 to 7 years. You're going to statistically do something with that within that 5 to 7 year term, or even quicker. If it's first-time home buyer, it is very quick. There's no prepayment penalties on these. And you can refinance at any time for our low closing costs, as I told you earlier. These are great for first-time buyers too. And I found first-time buyers are a little more amenable to looking at a 5-1 ARM as opposed to 30-year fixed, because I'm 59. My parents don't like mortgages to begin with, and they certainly don't like adjustable rate mortgages. And there is the big fear, because back in the day with the nightmare stories, the caps, and we'll go into that in a second, these things would blast up to 18%, and these people would lose their house real quick because they couldn't afford a payment. That doesn't happen now. Let's look under the hood of a 5-year ARM product. So the initial fixed period on this product will be for 5 years. The interest rate remains the same, currently at 4.5%, and that's the payment, principal and interest. People are like, okay, what goes on after the initial 5 years? There's a couple different factors with ARM products. One is the caps, and we'll go into the caps. My standard caps on this product are 2% and 6%, and let me go in and explain that a little bit. A cap governs the limits of where this ARM could go when it starts adjusting. The 2% is 2% per adjustment after the initial 5 years. So in the beginning of year 6, this thing can't go beyond 6.5% if it starts at 4.5%. Does that make sense? Okay, so it does become a 1-year ARM after the first 5 years, so it can adjust up 2 percentage points or down depending on where rates are going at the end of the 5th year into the 6th year. And then at the end of the 6th year into the 7th year, it can adjust up or down maximum of 2 percentage points from that previous rate. And then the same with the 8th year. Now, if rates just skyrocketed, the maximum this could go, and it's called a lifetime cap, is 6%. And you'll see that 2-6. So when you see this designation, this usually means first adjustment and subsequent adjustments maximum, and that's lifetime cap. So theoretically, this could not go beyond 10.5% ever, regardless of what interest rates do. And just realize people, when interest rates go higher, if they don't shift too quickly, they become adjusted to them and become adjusted to making greater payments. So this will edge up if interest rates do run higher, but it doesn't necessarily mean it's going to go up. It's based on the second part of an adjustable rate mortgage. Does anybody have any questions about the caps? I can lose people on these caps. 2% per period, stay fixed for 5 years in this program on a 5/1 ARM. It can adjust 2 percentage points up or down every year after that, but it can never go beyond 6% over the initial note rate, which today would be 4.5 plus 6% is 10.5. Pretty clear? Clear as mud? Okay, cool. I do this every day, so explaining it is, let me know if I lose anybody on it. The other part of this is the how it adjusts. This product, with a variable rate mortgage, you have an index and a margin. So the index is the variable portion of an adjustable rate mortgage. Indexes, prime rate is an index, LIBOR is an index, and treasury bills are indexes. So in this one, we use a 1-year T-bill as our index. That is a variable portion. So when this adjusts, we look at the 1-year T-bill, and we look at that rate plus a margin. And the margin is the fixed portion of a variable rate mortgage. Our margin on this product is 3.75. Those can vary. So indexes and margins can vary from bank to bank, institution to institution, and even ARM product to ARM product. So in this example, I'll give you an example. If rates remain the same today, our margin being 3.75, the 1-year T-bill is about 4%. So this would float towards 7.75% at the end of 5 years and the beginning of 6 years. However, it's what? Capped, right? So the first adjustment can't go above 6.5%. Currently, if you took this 4.5% 5-year ARM and did the maximum adjustments in year 6, year 7, and year 8, which is 10.5% in year 8, you blended all those together, the blended rate would be 6%. This is important to remember. The blended rate would be 6%. So even at the end of year 8 with maximum adjustments, which probably statistically won't occur, you could tell somebody this blended rate, and I'll give them that detail, but if you're at 7% and your blended rate of what you paid over 8 years is 6%, you're still better off not going with that 30-year fixed. And that's through the end of year 8. And on $250,000, I think it saved like $23,000 in the first 5 years, and it decreased to, with maximum adjustments, they still saved $16,000 after year 8 by going with a 5/1 ARM, even with maximum adjustments in the year 6, 7, and 8. So I mean, that's a ways, and they can always refinance. So one of the things I talk to my clients about is let's look at the differences. If you're looking at a $250,000 loan at 7% and one at 4.5%, that difference $400 a month in monthly payment. $400. So they save $400 a month for the first 5 years. That's really significant. And I think the main thing before we move on to the last part is when you're speaking with your buyers to say, hey, have you taken a look at this? And they go, I'm not touching an arm. Has anybody had that? I hope everybody has had that. I'm not touching an arm. I know what they can do. They don't. If there's a huge amount of savings that they can receive from going with an arm and lowering their payment and making that home affordable, and they can refinance it at any time. I think the main thing is turning that over and having that conversation to say, hey, can I have Mark reach out to you and go over the detail on it? I guarantee you, once I sell this to people, those fixed rate buyers have turned into ARM buyers. Whether or not they'll do it in the future, but once you show them the spread and the payments and the risk, that it reduces their mental risk and their fear of that thing going to 18 or 20% or whatever their thoughts are. Because they have a lot of fear of what it could possibly do. And it won't even go there with the caps to begin with. But when they look at the savings and I can calculate that for them, usually they're flipping over to an ARM. So I always actually recommend this, even if my buyers say, I'm not an ARM guy. I say, hey, you want to take a look at the difference because I'm at 4.5%, and that's significant. $400 on a $250,000 loan.